There is a moment in everyone's financial life when a simple question appears, usually late at night, when the world is quiet and the mind begins to wander. What would it take to build a stream of income that arrives every single month, even when you do nothing at all? Most people imagine huge numbers, complicated systems, or something reserved only for the wealthy. But the truth is far more surprising, and it hides behind an idea so small that almost everyone ignores it. The mystery begins with the promise of $1,000 a month. A goal that feels both close enough to dream about and far enough to doubt. Yet the real puzzle is not the amount, but the cost of creating something that lasts. The idea of steady income without daily effort is not new. More than a century ago, long before modern markets existed in the form we know today, companies were already sharing a portion of their earnings with the people who believed in them. Early investors did not have charts or digital tools. They had trust, patience, and a slow awareness that businesses could reward loyalty in quiet, dependable ways. The simple act of sharing profits was the seed that grew into the dividend system. It started humbly, with shipping companies and railroads, industries that connected distant places and needed capital to expand. These companies promised regular payments to anyone willing to support their growth, and a new kind of financial future was born. Over time, this system expanded far beyond basic transportation. It reached banks, factories, and even small local businesses that wanted to attract investors. People realized that owning a small piece of a company could create long-term security. What began with cautious optimism evolved into a structured financial framework that exists to this day. The rise of large corporations and the creation of organized exchanges added predictability. Investors gained access to reliable records, clear expectations, and a long-term view that allowed confidence to grow. Every generation built on the last, refining the system but never changing its core purpose. A dividend was simply a way of saying thank you for believing in a business. But behind that simple thank you lies the hidden cost of building a machine that pays consistently. The cost is not only measured in dollars, it is measured in patience, timing, and understanding how money behaves when given enough room to grow. The path from an empty portfolio to $1,000 a month is not a straight line. It begins with understanding the forces that shape this system. When companies became larger and the economy expanded, investors faced new challenges. They had to learn to separate real value from empty excitement. They had to understand that steady businesses grow slowly. They had to understand that stability often hides behind quiet performance rather than loud movements. This quiet performance is what makes the $1,000 goal so unusual. It feels simple, but the foundation behind it stretches decades into the past. The rise of modern investing brought new opportunities and new expectations. When stock markets matured and legal protections improved, more people felt safe investing for income. This was when the idea of building a personal income machine truly emerged. People no longer needed to build a business or buy property to earn consistent returns. They could own a fraction of one company or many companies and receive small payments that added up over time. The journey became accessible, predictable, and measurable. Still, most people never understand the true cost because they focus on the reward rather than the structure. They imagine receiving money every month, but they rarely think about the machinery behind it. They think about the $1,000, but not about the capital required to make it happen. They picture the outcome, but they do not see the slow construction process that came long before. History shows that every strong dividend stream began with small steps that did not look powerful at the time. Quiet decisions, modest contributions, long waiting periods that tested patience. The cost was not only financial, it was emotional. It was the discipline to stay consistent during moments when nothing seemed to be changing. This discipline is what separates the goal from the fantasy. The origins of steady payouts came from businesses that survived storms, competition, and entire economic cycles. Their resilience created trust, and that trust made the income possible. Today, investors rely on the same structure. A dividend-paying company must earn steady money, manage its operations carefully, and maintain long-term strength. When you invest in these companies, you are not just buying stock. You are buying into a process shaped by decades of financial evolution. You are placing your confidence in systems built through trial, error, and adaptation. And yet, even with all this history, one question remains unanswered. What does it actually cost to build a personal dividend engine that produces $1,000 every month? Most people guess too low or too high. Few understand the moving parts, the math behind the scenes, and the hidden forces that quietly determine how long it takes. The surprising truth is that the cost depends less on the number itself and more on how well you understand the journey behind it. The story of building this machine begins much earlier than anyone expects, and the real price reveals itself slowly. It appears not in sudden gains, but in steady progress, shaped by choices that compound quietly until the moment everything clicks. Building a dividend machine that produces $1,000 every month is far more intricate than most people imagine. At first glance, it seems simple. Pick a few companies, buy shares, wait for payments, and collect your income. But the reality is hidden in details that almost no one considers. Dividends are not random. They are the outcome of careful corporate management, market cycles, and broader economic trends. Each company's ability to pay depends on its earnings, its strategy for growth, and its decisions during crises. Even the strongest dividend-paying companies have faced periods of pause or reduction, reminding investors that the pathway to predictable income is never guaranteed. Understanding the cost requires seeing how compounding interacts with patience. Imagine beginning with nothing. You start small, purchasing modest shares. Every dividend payment is reinvested. Over months and years, this snowball begins to grow. The first payments are tiny, almost unnoticeable, yet they lay the groundwork for something much larger. This is the hidden beauty of dividends. They are steady and cumulative. The real cost is not in missing a large windfall, but in maintaining consistency, discipline, and a long-term view, even when results feel minor. The historical perspective illuminates why dividends are so reliable. In the early 20th century, the largest industrial companies of the United States relied heavily on reinvesting profits into expansion. Yet many also shared a portion of their earnings with investors, creating a precedent for consistent returns. Railroad companies, energy providers, and manufacturers became the backbone of early dividend strategies. Investors who understood the value of steady payments could survive economic shifts while still accumulating wealth. These early lessons remain relevant today. Dividends are not merely payouts. They are signals of stability and resilience, reflecting decades of corporate evolution. The rise of technology and the global economy added new dimensions. Companies became more complex, markets more volatile, and returns less predictable. Investors learned that relying on price appreciation alone could be risky. Dividend-paying companies offered a different approach. Even if the market value fluctuated, the income persisted. Over time, a strategy of selecting companies with strong balance sheets, consistent cash flow, and a commitment to share profits became the cornerstone of building a reliable dividend stream. The challenge, however, was in recognizing which companies would maintain payouts during downturns and which would falter under pressure. One critical insight is that building a $1,000 monthly dividend machine is not simply a function of stock prices. It is a function of yield and scale. The effective yield of a portfolio determines how much each dollar invested contributes to monthly income. High-yield stocks promise more immediate payments, but often come with greater risk. Lower-yield companies may pay less initially, but offer greater stability. Balancing these factors is where the hidden cost emerges. Investors must accept slower initial growth and resist the temptation to chase short-term returns. The real price is patience, education, and calculated risk management. Modern parallels make the picture even clearer. Today, interest rates are lower than decades ago, meaning fixed-income alternatives provide minimal income. Dividend-paying stocks offer one of the few paths to meaningful passive monthly income, but the numbers must be approached realistically. Achieving $1,000 per month often requires 6 figures of capital, diversified across multiple companies and sectors to mitigate risk. Investors who underestimate this requirement frequently become frustrated when expectations clash with reality. They may assume that small portfolios can produce large payouts immediately, without realizing the structural cost of time, capital, and strategy. Behavioral patterns also play a hidden role. Individuals often react emotionally to market fluctuations, buying impulsively during optimism and selling during pessimism. These behaviors quietly erode the effectiveness of dividend strategies. The cost is not in the dollars themselves, but in the decisions that undermine steady growth. Historical cycles show that investors who remain disciplined, reinvest dividends consistently, and focus on long-term stability outperform those who chase trends or attempt to time the market. The lesson is subtle. Building a dividend machine is as much about mindset and resilience as it is about mathematics and finance. The reality of compounding returns cannot be overstated. Early reinvestment of dividends accelerates the growth of the income stream over time. What begins as a small, almost symbolic payment gradually transforms into meaningful monthly cash flow. Each additional investment, each disciplined contribution, and each year of patience compounds the results. The true cost, therefore, is not simply the initial capital. It is the dedication to a plan that grows slowly, often imperceptibly, until it achieves a scale capable of delivering consistent monthly income. Finally, there's a hidden element of education. To make informed choices, investors must understand financial statements, dividend histories, payout ratios, and sector risks. Knowledge itself carries a cost in time and effort, but pays dividends in the long run. Every dollar invested without this understanding carries an unseen risk. The process of learning, analyzing, and applying insights is what transforms ordinary investors into those capable of constructing a reliable, resilient dividend machine. At this point, the framework for the $1,000 monthly goal begins to solidify. Investors can see why it is possible, yet why it is rarely easy. The machinery is quiet, cumulative, and disciplined. The cost is not only financial, but emotional, intellectual, and temporal. Once these elements are understood, the final steps toward building a functional income-generating portfolio come into view. The results are slow, measured, and highly dependent on the investor's ability to remain consistent, patient, and informed. The final steps in building a reliable $1,000 a month dividend machine reveal truths that most investors never fully grasp. By now, you understand that the cost is not only measured in dollars, but in patience, discipline, knowledge, and a willingness to endure quiet months where progress feels almost invisible. It is in those months that the machine is truly being built in ways that are hidden from immediate view. Every dividend reinvested, every cautious choice made, every lesson learned from past mistakes contributes to a foundation strong enough to carry income consistently into the future. Understanding this hidden process is what separates those who achieve steady financial freedom from those who abandon the effort too early. One of the first clear lessons is the importance of scale. To generate $1,000 per month purely from dividends, a significant amount of capital is required. Exact figures vary depending on yield, market conditions, and portfolio diversity, but the reality is that most investors underestimate the size of the investment needed. They imagine smaller amounts will produce large payouts instantly. The true cost, therefore, lies not in wishful thinking, but in confronting the numbers honestly. Accepting the scale requirement changes how you approach savings, reinvestment, and planning. It forces you to think long-term and focus on consistent contributions rather than chasing short-term gains. The second insight is diversification. No single company or sector can reliably produce a steady monthly income without exposure to risk. Markets shift, businesses face challenges, and unexpected events can reduce or suspend dividends. History shows repeating patterns of boom and bust, and even resilient companies are not immune to macroeconomic shifts. By spreading investments across industries, geographies, and yield types, an investor reduces the vulnerability of the income stream. Diversification carries its own hidden cost: more research, more monitoring, and more patience. But it is indispensable for transforming modest capital into a dependable monthly payout. A third lesson lies in understanding the behavior of compounding and reinvestment. Dividends themselves are only one piece of the puzzle. Early reinvestment accelerates growth, turning small payments into larger ones over time. The process is subtle and often goes unnoticed in the moment, which is why many abandon the plan before they see meaningful results. Those who stay disciplined witness exponential effects in the long run. The hidden cost, again, is emotional. Resisting the urge to spend or reallocate dividends prematurely is just as important as the financial calculation itself. Modern parallels reinforce why these lessons are essential. Today's financial environment is characterized by lower interest rates, market volatility, and a proliferation of investment options. Fixed income instruments rarely produce meaningful monthly income, and speculative high-yield opportunities carry heightened risk. In this context, a thoughtful, diversified dividend portfolio becomes one of the few realistic pathways to passive monthly cash flow. Shocking data shows that individuals who try to shortcut the process, chasing high yields without proper research, often experience setbacks, delayed goals, and in some cases, capital loss. The repeating pattern is unmistakable. Success comes quietly to those who plan, fail cautiously, and learn continuously. Once these lessons are integrated, the actual construction of the dividend machine becomes less mysterious. Investors begin to see how months of reinvestment, patience, and strategic allocation transform into reliable income. They understand that it is not one dramatic move that produces results, but thousands of small, deliberate actions executed over time. And they also see the psychological benefit. The knowledge that income is being earned even during periods of market calm or volatility provides a stability that cannot be overstated. The $1,000 monthly goal ceases to feel unattainable. It becomes inevitable for those willing to pay the true cost: patience, scale, knowledge, and discipline. There are three critical takeaways that summarize the entire process. First, achieving consistent monthly income requires realistic understanding of capital needs and yield expectations. Overestimating results leads to frustration, while underestimating effort leads to failure. Second, diversification is essential. Relying on one company or one sector exposes the investor to unnecessary risk, and history has repeatedly demonstrated the consequences of concentrated exposure. Third, patience and disciplined reinvestment are the most powerful tools available. Compounding quietly builds income over time, and the investor who respects this principle experiences results that appear sudden only in retrospect. Each takeaway reinforces the principle that building sustainable income is a process, not a gamble. The cautionary thought remains: the dividend machine is not immune to human error or market uncertainty. Economic shifts, unexpected corporate decisions, and global events can disrupt payouts temporarily. Investors who fail to plan for contingencies or who expect instantaneous results may abandon their strategy prematurely. Success comes to those who combine discipline with adaptability, who accept minor setbacks without panic, and who continue to learn from patterns repeating across decades of financial history. The final insight is simple: Building a $1,000 a month dividend engine is not about luck, timing, or instant wealth. It is about understanding the machinery, respecting the numbers, making informed decisions, and committing to a path long before the results are visible. When executed properly, it provides both tangible income and the mental clarity that comes from knowing your money is working steadily for you. It creates a sense of financial freedom that allows focus on life, relationships, and purpose, without the constant stress of chasing returns or fearing loss. If this perspective resonates, the next step is to take deliberate action. Review your current capital, research dividend-paying companies, plan realistic contributions, and commit to consistency. Even small steps taken today accumulate into meaningful results tomorrow, and the quiet, dependable flow of income that begins to emerge will not just pay bills or cover expenses, it will transform the way you think about money, control, and time. The machine does not need to be complex. It needs to be constructed thoughtfully, with patience, awareness, and long-term commitment. That is the true cost and the true reward.